Okay, let's jump right into this explainer and unpack a proposal that is frankly totally wild but highly innovative. We're looking at a massive social challenge, funding early childhood education, and asking, what if we didn't rely on traditional tax dollars? What if instead we combined some seriously cutting-edge private sector financial engineering with the literal monetary power of the Federal Reserve? Today, we're exploring how innovative financial tools developed by the private market could, theoretically, package human potential into actual tradable assets.
Here's our roadmap for this explainer. First, valuing early childhood education. Second, private sector financial tools. Third, the Fed as asset buyer. Fourth, Treasury accounting and gifts. And finally, precedents and legal limits. Let's trace the financial plumbing.
Section 1. Valuing early childhood education, or what they're calling the 13x human capital jump. We're starting with a stark problem: at-risk children lacking access to high-quality early education. In the U.S., this gap happens because we rely heavily on federalism and private markets, unlike other Western nations with more universal public systems. But what if we used those exact same private market forces to actually solve the funding gap?
$75,000. That's the ambitious starting line right there. It represents the estimated base cost to fund high-quality early childhood education for just a single at-risk child up front, a loan originated entirely by the private sector.
And then we have $1 million. This is the private sector's incredibly bold claim for the return on that initial investment. They argue that if a student hits the best measured outcomes defined, the lifetime societal returns, when you bring them into today's dollars, equal a whopping $1 million per child.
Now you're probably wondering, how on earth does 75 grand turn into $1 million? This massive, basically 13 times multiple, isn't just pulled out of thin air. It is backed by landmark, peer-reviewed economic research. We're talking about famous studies like the Perry Preschool and Abecedarian Project. They tracked students well into adulthood and proved these exact long-term benefits. Things like improved cognitive skills, way higher adult earnings, dramatically lower crime rates, and reduced welfare reliance. The private sector is taking these proven benefit-cost ratios, which regularly exceed 4-to-1, and using rigorous financial modeling to say, hey, there is a tangible, tradable market value to this human potential.
Moving on to Section 2, Private Sector Financial Tools and Structuring the USAValuesDebitBond. This is really the absolute core of our explainer, where we look at the exact, innovative financial solutions engineered top to bottom by the private market.
Here's how the pipeline would actually work. First, private actors originate the loans to fund the education. Then, crucially, they meticulously measure the educational outcomes over time. Step 3. They package these outcome-backed loans into a brand new financial instrument called the USAValuesDebitBond. And finally, they bring the receipts, presenting rigorous, independent evidence to buyers. The private sector is completely in the driver's seat here, creating the tool and proving its value.
Notice how the private sector proposes structuring this bond into tiers, a technique called tranching. It's actually a lot like what we saw in The Big Short, but instead of toxic, opaque subprime mortgages, this uses completely transparent, measurable education outcome data to dictate the value. The best tier, the kids hitting the highest measurable impacts, targets that full $1 million present value and carries the lowest risk. The worse the measured outcome, the heavier the discount. It's this incredibly fascinating private market mechanism designed to reward actual, mathematically proven human success.
Which brings us to Section 3, the Fed as asset buyer, monetary support and risk assessment. So once the private sector builds and tranches this bond, the next step is presenting it to the Federal Reserve as a potential asset buyer or liquidity provider.
The absolutely crucial thing to understand here is that the Fed wouldn't be flying blind. They routinely evaluate these exact types of securitized products, bundles of loans packaged together. While the private sector is the one defining the best measured outcomes, the Fed would step in and apply its own independent liquidity, policy, and risk analysis right on top of those claims. They are completely equipped to differentiate values across these outcome-based tiers. But the way the Fed evaluates assets has drastically evolved. Before the 2008 financial crisis, the Fed relied super heavily on private rating agencies like Moody's or S&P to figure out an asset's quality. Post-2008, the reality is very different. Sure, the private sector might use specialized outcome raters for these early education bonds, but the Fed would rigorously supplement those ratings with its own conservative modeling and really intense internal stress testing. Basically, they aren't just going to take Wall Street's word for it. They will independently verify those long-term economics.
Next up is Section 4, Treasury Accounting and Gifts, the Federal Reality Check.
This is where our financial plumbing journey hits its final destination, the U.S. Treasury, where ambitious private sector valuations meet the cold, hard reality of government accounting.
So the proposal suggests the Fed could act as a conduit to sort of gift the value of these bonds to the Treasury to support fiscal goals. But under federal generally accepted accounting principles, or federal GAAP, the Treasury can only legally record the actual tangible cash it receives. Think of it like a strict cash register. Even if a private firm perfectly structures a bond and claims $1 million future value based on societal savings, the government literally cannot just ring up $1 million on day one based on a private market promise.
The reality of the situation is that the Fed's remittances, or gifts to the Treasury, are based on actual net profits generated from their operations after expenses. The Fed's balance sheet is highly scrutinized and independently audited. They don't and can't just instantly mark up assets to match private valuations. So what this means is that while these private sector financial tools are incredibly innovative, at the end of the day, they ultimately have to survive the incredibly strict conservative filter of central bank accounting.
Finally, Section 5, Precedents and Legal Limits, Public Statutory Power versus Market Liberty. To wrap up this explainer, we really need to anchor this theoretical proposal in legal reality. Basically, can the Fed actually even do this?
Well, the mechanics are actually feasible because they build directly on crisis-era innovations. Remember back when markets completely froze in 2008? The Fed created special emergency facilities to evaluate and purchase complex, tranched securities just to stabilize the economy. They used quantitative easing to buy up mortgage bonds. So the actual infrastructure to buy something like this proposed USAValuesDebitBond, it already exists.
However, there is a very clear boundary here. As former Fed Chair Ben Bernanke's memoirs highlight, while the private sector has the market liberty to innovate, to crunch the data and build these intricate structures, the creation of monetary policy is strictly a public statutory power. Wall Street can absolutely bring this brilliant idea to the Fed's doorstep, but the legal authority to actually buy the asset and set the terms, that rests entirely with the Federal Reserve acting under laws passed by Congress. It's not a private sector right.
And we can't overstate this. That power is immense. This is the institution that sets your mortgage rates and backstops global banking. This distinctly American proposal is attempting to harness that deeply concentrated balance sheet power that normally bails out banks or stabilizes volatile financial markets, and aim it squarely at targeted human capital investment.
It is just a fascinating blend. It leverages the absolute best of private sector financial engineering and outcome measurement and attempts to marry it to central bank flexibility. It forces all of us to ask, is this the ultimate modern solution to scaling early education without relying on gridlocked government spending? Can the math of Wall Street actually save the future of Main Street's children? It's a wildly complex proposal, but if it works, it could change how we fund the future forever.